Hey guys, what's going on? A few years ago, when my channel was starting out, I did this video. It was called Is Cash Trash? And in this, I argued that in the short term, cash may not be trash, as a lot of people that I follow are saying that, hey, fiat is worthless, this and that. And yes, I do agree there are a lot of problems with fiat money and what the Federal Reserve is doing and what our government is doing to our economy. That being said, I said in the short term, because of how the dollar is structured, since it's a basket of fiat based currencies, the dollar may initially soar, or you may see an appreciation of the dollar. And in this, I outlined the euro consists of 57% of the dollar index. And then the Japanese yen, roughly 11%, and the pound thereafter 10%. So if you add the euro composition, the Japanese composition, and the British pound composition, that's close to 80% of the dollar index. And then followed by there's a Canadian dollar, there's the Swedish krona, and then there's the Swiss franc, consisting of the dollar index. So people are saying, hey, the dollar's going up. Well, it's only relative compared to the euro currency and the Japanese yen. And then you could say the pound as well. Those three currencies. But the biggest component of the dollar index is the euro. So now I'm going to one individual who's a libertarian, Jeff Goodlodge. Even though he's libertarian, he just looks at the charts. He puts his libertarian bias out the window, and he said earlier that the dollar would break out. And this is quite interesting. He said the dollar would break out right here. And he said actually in 2010, this is actually a 2014 chart, but he said a few years ago that the dollar index would be heading higher. So let's look at this article at Business Insider. But in making that call, Goodlodge was following up on something he'd said back in 2010, 2011, which is that the dollar, which had been in a nearly 30-year bear market, was finally reaching a bottom. That's an interesting call, where now you see a potential breakout in the US dollar index. It has broken the $90 threshold, which I talked about before, and I said that, hey, if it gets above 90, or this was in my thoughts if I didn't say it in a video, if it got above 90, it could potentially break out. But 90 was an important resistance level, 89.90, and now it got there. And beginning of first quarter next year, I do believe that there's going to be a lot of turmoil, and the dollar trade as of right now is overcrowded. So you may see a reversal in the Dixie index. And then from there, who knows? I mean, let's look at this again, right? I said that the Japanese yen composed 10-11% of the dollar index. So if the Japanese yen depreciates against the US dollar, this will put upward pressure on the US Dixie index. Long story short, next year I do see the dollar yen going to maybe 140-ish. I wouldn't be surprised. Earlier this year it was 105. 1 year ago, December 31st. Now it's at 120. So, I don't know, do the math. 135 to 140. I wouldn't be surprised if it hit that level. And then the equity markets slowly but steadily move higher as well. But that being said, I do believe that we are close to the top in the stock market. I mean, like I said, every 8 years we tend to see the stock market topping out. 2000, with the change of election, you had Clinton hand the baton to Bush. Bush handed the baton on to Obama in 2008 when the Lehman Brothers crash happened. The Dow plunged. I believe the same thing is going to happen this time, how Obama is going to give a rotten economy to the Republicans. Who knows who's going to be the president? Rand Paul? Chris Christie, Jeb Bush, hopefully not another Bush, but we shall see that in the years to come. Alright, now I'm at the Huffington Post and I see this: new rules, Cyprus-style bail-ins to take deposits and pensions. So for those individuals that don't know what happened in Cyprus last year, over a year and a half ago, Cyprus had a banking crisis, and in order to avert a 1930s style depression, deflationary depression, what ended up happening was big banks were taxed, or individuals with large deposits were taxed, and that was used to facilitate this process of averting a 1930s bank run. And individuals had trouble getting money out of the bank. Individuals only were allowed to take maybe $100 a day, some small amount. So it was difficult in trying to pay simple bills. That's how crazy it was. A lot of people unfortunately lost their jobs. And in this article, it appears that a lot of these G20 countries are going to adopt these principles when the time comes of a new banking crisis. Let's just read this. I'll start from here. It was all so fast, the first paragraph. They may have not known what they were endorsing when they rubber stamped the Financial Stability Board's adequacy of loss-absorbing capacity of global systemically important banks in resolution. How about that for a long phrase? Anyways, let's continue on. Which completely changes the rule of banking, or rules of banking. Russell Napier, writing in Zero Hedge, called it the day money died. In any case, it may have been the day deposits died as money. Unlike coins and paper bills, which cannot be written down or given a haircut, says Napier, deposits are now just part of commercial banks' capital structure. That means that they can be bailed in or confiscated to save the mega banks from derivative bets gone wrong. Rather than reining in the massive and risky derivatives casino, the new rules prioritize the payment of bank derivatives obligations to each other ahead of everyone else. That includes not only depositors, public and private, but the pension funds that are target for the latest bail-in play called bail-inable bonds. So there we go. Let's just look at this one important post as well. Let's go to here. It says, in theory. In theory, U.S. deposits under $250,000 are protected by the FDIC insurance, but deposit insurance funds in both the U.S. and Europe are woefully underfunded. That's the key word, underfunded, particularly when derivative claims are factored in. So, like I said before in previous videos, the FDIC is a Ponzi scheme. It does not have the available funds to bail out the mega banks. So what, in my opinion, they're going to do the next banking crisis, most likely, in my opinion, 2016, 2017, if the derivatives bets go bad, go sour, in my opinion, they're going to be bail-ins to avert the 1930s crash that a lot of individuals are fearing. There are guys like Harry Dent saying that we're going to go back to Dow 5000-ish. Hey, it could potentially happen, but what I'm saying is I'm more in the line of thinking that the equity markets are going to have a hard landing, but in my opinion, I'm looking at a level between 11,000 and 12,000. Could it overshoot much lower than that? Yes. But this is what's going on in my head right now. We shall see what happens in the next few years. So what does this mean? Going back to the original point of the video, is cash trash? In the short run, I don't think cash is trash. I mean, yes, there are problems with fiat money, but at the end of the day, what I'm doing is I'm looking at, okay, the banking system is fragile. I mean, yes, there are a lot of people that are positive about the economy. 2 years from now, I think a lot of sentiment will be really, really bearish, and that's the time I'm probably going to load up on the equity markets, when everyone is crying bloody murder, right? When there's blood on the streets, that's when I'm going to get in. I mean, yes, I'm doing some trades here and there, but what I'm doing right now is I'm just stashing cash. I mean, yes, I have the inflation part of my portfolio down. I have a lot of gold and silver, or I have a lot of silver. I have mining shares. So what's the other part of the equation to hedge myself against the inflation part? What if I'm totally wrong about the inflation part in the long run? I still have the deflation case, and that is just stacking cash. A lot of people will not agree with that strategy, but if you look at 2009, how the equity markets fell 50-60%, a lot of people wish they were in cash. And that's the other part of my strategy. Just load up on cash and then not go all in 2016, 2017 if the markets crash, but just to make large bets that I was not making during this bull market. And I think that Dow 11,700 seems really attractive, or the S&P around that level, maybe like 130, 140 on the SPY. And if you want to look at the Russell IWM, maybe in the 60, 70 range. If it ever hits that, I'm just going to be loading the boat. But we shall see how markets react, and I'm stashing cash right now. I mean, before I was stashing metals, I have enough of that. Now the other part of the strategy is, okay, hedge myself against what the central planners called deflation. But once again, I believe in a diversified set of strategies. Don't go all in my opinion, in everything. Thanks for listening to me, guys. Let me know your opinion. I'll talk to you later. Bye.